Hey everyone, Haley Gant here with Quest Trust Company. In today's video, I am really excited to bring a guest with us. Today we have Adam Barr. Adam is a CPA and is very well versed in all topics of UBIT, or Unrelated Business Income Tax, which when you're dealing with self-directed IRAs is really always a hot topic of conversation. So Adam has actually brought us a great format of Q&A questions today that we're kind of going to go through. And if you guys have more questions about UBIT after this video, feel free to give us a call at Quest or feel free to reach out to Adam. And let's get right into it. So Adam, kind of tell us a little bit about who you are and what you do.
Sure. So everybody, my name's Adam Barr. I'm a tax manager at Miller Grossbart Advisors, which is a local CPA firm here in Houston. We do work with our clients around the country and around the world on small business tax issues, on real estate investing, multifamily investing, commercial real estate investing, and a wide variety of other types of businesses. Most of our clients are here in Houston, but we do work with people around the country. I accidentally got into UBTI. It wasn't an intentional thing. Working so much in multifamily, a number of my clients who are multifamily partnerships had investors who were investing through IRAs, and actually most of them through Quest. So when I went to a real estate investing meetup, I met some folks from Quest there, and I said, "Hey, I know who you guys are." And we kind of hit it off, and that's the rest is history. But I've been working on unrelated business income tax filing and reporting here for maybe 5 or 6 years. And I do a lot of this type of work to help out Quest clients. And I actually don't know any other CPAs who handle this sort of thing and handle it well. So I do enjoy it. And yeah, that's I guess what I have to say.
Yeah, and that's so true. That's one of the reasons we're super excited to have you on here today, is because UBIT is one of those topics as a self-directed IRA custodian where we can't give tax advice. You know, some of it goes beyond our realm of what we can talk about. But the next step is to talk to your CPA, which most CPAs out there aren't really familiar with UBIT, nor are they experts by any means on the topic. So it's really great to have you here today. So to kind of get started, first, main question, getting right into it. What is UBIT? What is UBTI? A lot of times you hear those two terms kind of interchanged together, but kind of what is it? Give us a brief overview of that.
Yeah, absolutely. So UBTI is an acronym that stands for Unrelated Business Taxable Income, which is a separate and distinct concept from UBIT or UBIT, which is Unrelated Business Income Tax. So just like if you were to think about the realm of regular tax, like, ordinary folks pay, you have your taxable income, which is the income that you're being taxed on, and then you multiply that by tax rates or whatever, and then what you end up is having the tax that you pay, which is the tax. So if we think about it in that format, then UBTI is the taxable income that the tax-exempt organization or IRA earns, whereas the UBIT is the actual tax that's being paid. So it's just important to understand the distinction between the two terms. Going a little bit more into what is unrelated business taxable income, or UBTI, basically it's income generated by a tax-exempt entity by means of taxable activities. And a tax-exempt entity here doesn't just mean a nonprofit organization. It means things like retirement plans and IRAs, which is why we're having this discussion today. So the majority of what we're talking about today will be focused on the world of IRAs. The purpose of the tax itself, the UBTI, is to sort of eliminate unfair competition by placing a tax-exempt entity's business activities on the same level as a for-profit entity's activities. So for example, if you're running your business as a corporation and you are, running a restaurant or whatever it is, then every year when you get your net income from the business, you have to pay tax on it. And what you have left to operate your business and to invest in the growth of your business is basically your after-tax dollars. Now, if I was a tax-exempt entity or an IRA and I was operating a restaurant, prior to the existence of UBTI, then I would never pay any tax. So I would have 100% of my cash flow available to pay expenses and to grow the business and so on. And so you can see that in that case, an IRA would have an upper hand over regular businesses because they don't have to pay tax. So the stated purpose of the tax is to sort of level the playing field by making IRAs pay tax and other tax-exempt organizations pay tax when they're operating a business for profit. And at least that's the stated reason. And I think the real underlying reason is that the IRS wants to collect more tax dollars. So that's fine. That's their job.
Yes, exactly. And I know one thing that I've always kind of heard the term say is an ongoing trade or business within the IRA could incur UBTI. But let's talk a little bit about what types of self-directed IRA investments incur UBIT. Is it all of them, or is it only certain types of investments? And why is it only these certain types of investments that will trigger UBIT?
Well, that's an excellent question. There are basically two scenarios that would cause an IRA to have unrelated business taxable income. The first would be if the IRA actually conducts something that would be considered an ongoing trade or business, which is a term you just referenced. Something I commonly see IRAs do that falls into this category is flipping homes. So buying a single family rental property or a single family home and renovating it and then selling it at a gain, like pretty soon thereafter. And we can come back and talk about that in a little more detail in a moment, but I wanted to get to number two, which is anytime an IRA has income from a debt leveraged asset, then it's probably going to have UBTI related to that asset's income. So this set of rules is called the Unrelated Debt Finance Income Rules, or UDFI, and it basically says if you have your IRA and it borrows money to buy an asset, then you're going to have to pay some tax on the income that that asset earns. And it really applies to any asset that's debt leveraged in the IRA. So even if you borrowed money in the IRA to purchase like a municipal bond, and that was a debt leveraged municipal bond, the interest income would become taxable income in the IRA because it's a debt leveraged asset. The most common examples, though, are when people buy rental properties, either single family rental properties, or if they invest in like purchasing an apartment complex or something like that. It's very much the industry standard that you're going to be taking on leverage when you buy those assets, maybe 70% or so. And so it's quite common for these IRAs to have to pay tax when they're in these deals. So just to go into that a little further in a way that probably applies to a lot of the folks listening, if you use your IRA to invest in an LLC, and that LLC is buying an apartment complex, and that apartment complex is bought with debt, which it is 99% of the time, right? Then you're very likely going to have UBTI from that rental property, especially at such time that it sells and you have gain on the sale of the property. So it really behooves you to think about the tax implications on the front end so that you understand what your after-tax return is going to look like inside the IRA.
Mm-hmm. Yeah. And that brings up a good question that I actually don't really think is on our list, but if someone invests into an apartment complex or an investment that's going to trigger UBIT, does it always occur immediately, or does it only start to occur once there's profits showing from that investment?
Great question. And I actually don't think that was on the list, so good call. In multifamily real estate deals in particular, it is quite common for there to be losses in the first several years of operations after depreciation. And so it's more common than not that you actually won't have a tax liability within the IRA until such time that that property sells and there's a gain on the sale. That being said, it can happen. I was just talking to a client yesterday that he bought into an LLC that bought a multifamily rental property, and he's going to have UBTI this year, even though the property didn't sell, because they made a lot of money on operating the property.
Mm-hmm. Nice. So let's say someone's done an IRA investment and that IRA investment does incur UBIT, or they think it's going to incur UBIT. How is that reported? Is that like a certain tax form? what process would someone go through to actually figure out if there is UBIT to be paid and then going through and paying the UBIT?
Sure. It depends on the type of investment, how you would figure that out. But starting with sort of the basics, an IRA would be required to file a Form 990T if it had UBIT, UBTI, excuse me. And this is basically a tax return for the IRA that reports the UBTI and calculates the tax due. As far as who would do that for you, the first answer I think of is me, of course. I would do it, and but any CPA that has the appropriate knowledge and is willing to do it can probably do it for you. I wouldn't probably recommend doing it yourself because there is some math involved with the way things are treated differently under the UBTI rules. So it's not quite as simple as it appears to be on the surface. Is that the answer you're looking for?
It does, yeah. And it's funny how you say as simple as it appears on the surface, which for most people does not even appear simple. So, really getting with the right professionals, at Quest, we can answer a lot of conceptual questions about UBIT and UBTI. It's funny, I think what I usually refer to as UBIT is actually UBTI, kind of like a lot of people out there. But, if someone needs to file a 990T, say their IRA has incurred UBTI, what is the due date? Is that tax filing deadline? Do they get extensions? What's the deadline to make sure that they get that 990T filed each year?
Yeah, the deadline every year except for pandemic years is April 15th. This year, for the first time in history, the IRS moved the entire tax deadline from April 15th to July 15th. So this year, the due date's July 15th. But generally, it's April 15th. Which means you kind of have to keep an eye on it because a lot of these multifamily LLCs, they issue their K-1s like toward the end of March. So it doesn't give you a lot of time to figure out whether you need to file a 990T or not. You can file an extension and you can extend it until October 15th, but any tax that you owe actually has to be paid by the April 15th deadline. So you just want to make sure that when you get your K-1s, you're looking at them, you're talking about them with your tax advisor. For folks who aren't getting K-1s, people who have their own rental properties or other type of assets in their IRA, if you have gross income of more than $1,000, then you're going to need to file a 990T, whether that property operates at income or operates at a loss. So I would say to everybody, get with a tax advisor sooner rather than later. Don't wait until right before the deadline, because then it's hard to pull all the information together to get an extension and make sure you pay the right tax and all that. So just try to be proactive where you can.
Yeah, and that's interesting that you say that. So you can file for an extension through October, but the tax itself is still due in April. So kind of need to know what you're filing in order to pay the tax, it seems like. And just to clarify on that, would it be you as an individual filing for an extension, or would it actually be your IRA that needs to file for an extension in that case?
You continue to ask all of the right questions.
I'm a nerd.
Your IRA has to file the extension. Your IRA, this is a great time to have this discussion. Your IRA is a separate taxpayer from you. It is not you. The K-1s that the IRA receives have no impact on your personal tax return. The things that you do personally have no impact on your IRA's tax liability. We may talk about this a bit later in the presentation. I don't recall, but your IRA has to pay its own tax. So if your IRA owes UBIT, then it has to pay that from the IRA funds.
Yeah. All right. So moving on to the next question. Using a single family rental property as an example, let's compare how UBTI would be calculated compared to taxable income under standard tax rules.
Sure. So if we're talking about a rental property that's a single family rental, if you own that personally, like not through an IRA, if you're just Jane Doe and you own a rental property, then your taxable income is computed as your rental income that you collected minus all the expenses you paid, like your taxes and insurance and so on, and then minus depreciation. And the net of those numbers equals your taxable income that you're going to pay tax on. You often have accelerated methods of depreciation available to assist with sheltering that taxable income. So for example, if you buy some appliances for your single family rental, under current tax law, in the current year, those are eligible to be expensed 100% immediately. And so you can often shelter a lot of taxable income that way. Not so if an IRA owns that same rental property. So if Jane Doe used her IRA to instead buy that rental property, and it's debt leveraged, which it likely is most of the time, right? Then you have to compute UBTI. So first, you have to sort of compute what is the net income that your UBTI is based on, and then there's another step. So the first step is to calculate the net income of the property, which is going to be the rental income collected by the IRA minus all the expenses paid minus depreciation. However, in this case, all of the depreciation is computed on a straight line basis, and accelerated methods like bonus depreciation aren't available. So that can have a big impact. Sometimes that means that you end up with positive taxable income in the IRA when you would have had a rental loss if you had owned it personally. After you get to that point where you've computed basically the net income, expenses, and depreciation, you then have to reduce each of those items by more or less the ratio that the property was leveraged during the year. So let's just say, to make it a simple example, that you finance the property at 75%, then you would have basically 75% of the income from that rental property would be counted as UBTI, because that's the amount of the debt divided by the basis of the property. And it's actually more complicated than that, but that's sort of a surface level way to understand the general concept. So then you would just multiply your net income from the property by that ratio, which in this example is 75%, to determine the amount that is UBTI.
Perfect. So that is definitely something to consider. If someone is looking at a new investment property and they're considering, do I want to buy this with my own funds or with my IRA? Not only do they need to consider that, but they need to consider, if I buy this with my IRA, am I going to be leveraging the funds? Will that trigger UBTI, and how does that affect the overall calculation? So just kind of another layer of the due diligence, really, whenever you're looking at investment properties, and something to consider if you're deciding, should I buy this property in my own name or in my IRA? Because I know, no matter how many properties you buy outside of your IRA, you're getting depreciation, you're getting write-offs, you're still going to be generating more income that will eventually raise your tax bracket. So you definitely do want to shelter some of these investments, even though they might trigger a small tax within the IRA.
Sure. And you've reminded me to say something else, which is, just to be perfectly clear, if an IRA owns the rental property and it's not debt leveraged, you bought it for cash, then you have no UBTI and you have no reporting requirement at all. So I do see some folks do that. So if you have enough money in your IRA to do that, that's also a strategy you could think about. But you miss out on, obviously, the beneficial effect of having the leverage available to add more properties to your portfolio. Exactly. And something else to definitely consider there is, if you are planning on buying a long-term investment with your IRA, you're going to leverage the funds, which means that IRA or that investment will trigger UBTI. Over the course of the next 10, 20, 30 years, your equity in that property, as it goes up, the amount that's debt leveraged goes down. So eventually, over the course of that investment, the amount of UBTI each year does eventually decrease. Now, if someone pays off that rental property, say their IRA pays off that rental property, does the UBTI just go away? Are there any other kind of benefits there as far as completely tax-free at that point? Yes. If you pay off the property, then 12 months and 1 day later, you will no longer be subject to UBTI, because basically it looks back, what's your average debt over the prior 12-month period? So if you're going to sell a property that is debt leveraged and is owned by your IRA, and you have the ability to pay that property off either by, leveraging a different asset to get cash into the IRA or whatever it is, then you can actually avoid UBTI on the gain from selling that property by paying it off at least 1 year and 1 day before the day you sell the property.
Nice. Now, you mentioned something that's interesting. You mentioned something, leveraging another property to pay this one off. How would somebody go about doing that?
Well, it would have to be another property within the IRA. So, for example, if you had two properties in your IRA and one of them had debt and one of them didn't, and you wanted to sell the one that had debt, perhaps you could take a mortgage on the one that had no debt but you're going to keep and use the money to pay off the one that has the mortgage but you want to sell.
Mm-hmm. Very creative. I like that. I've heard some of our clients mention that before, but that is something that could definitely be a great strategy if you do have debt on a property in your IRA and you're looking to sell that property within the near future. Maybe something just to consider, maybe getting another non-recourse loan on that other property and kind of leveraging it there. We have some questions about the Tax Cuts and Jobs Act, but I'm going to save those, I think, because this next question after that kind of feeds perfectly with what we've been talking about.
Sure.
So my IRA has incurred UBTI. I'm filing my 990T. What are the actual tax rates of UBIT and UBTI? Are they different than normal? What type of tax rates are we looking at here?
Sure. So IRAs are taxed on their UBTI using the trust and estate tax rates, which are, the brackets are very, very, very compressed compared to the tax brackets that you guys are normally used to seeing, like you would use for your personal income tax. So just as an example, by the time you have $12,950 of UBTI in your IRA, you're already being taxed at the top tax rate, which is 37%. So if you're having a trade or business operating inside of your IRA and it's earning more than 12 grand per year, you might as well just assume that most of your income is going to be taxed at 37%, which is, it's a bit much, but it might still make sense if that's where you have your assets available to run the business, if you want to start the business in your IRA, or if you'd be paying that rate anyway, personally, then it doesn't really matter either way. But just to clarify, the 37% tax rate that starts at about $13,000 of income applies to ordinary income, which is really going to be rental income or income from a trade or business, like our example was flipping homes earlier. If we're talking about the gain on the sale of a rental property, that is actually a different type of gain. It's going to be a capital gain, and it's taxed at a much lower tax rate. So the maximum tax rate on capital gains is 20% within the IRA. And then if there's any depreciation recapture for depreciation that you took on the buildings, then that would be recaptured at 25%. So this is a lot of percentages and a lot of hoopla and everything. But if we wanted to boil it down to a simple example, if you're investing in a rental property, the most likely case is that you won't have much, if any, UBTI during the life of that rental property unless you hold it for a really long time. So we can just kind of focus on what happens when you have the gain on your disposition of the property. Basically, most of that gain will be taxed somewhere between 20 and 25%. So you're looking at an effective tax rate of 20 to 25%. Worst case scenario would be 25% tax on that gain.
And now, if I understand correctly, that say 20 to 25% is only on the percentage of the profits that are related to the debt. Is that correct?
Yeah, so that's a good way to look at it. So if at the time you sell the property is only 50% leveraged. So if your debt on the property at that time is 50% of your adjusted basis in the assets at that point in time, then you would only pay tax on half of the gain, not all of it.
Yeah, it's funny. I love talking to you about this because I am like at Quest, I am the self-proclaimed UBIT nerd, but I'm used to having, not like to dumb down the conversation for people, but I've learned how to really simplify an overview of the conversation. So now that I'm talking to you and I'm hearing all of the exact little intricacies, things like that, it's like, oh, I know what he's talking about. I just explain it like on a whole much simpler level most of the time. It's really interesting.
Well, I'd say the same. It's great talking to you about it because I don't often get to talk to folks that have a higher level understanding of the concepts, and you're asking all the right questions for the people who are listening. So they're in great hands if they're getting this information from you and me, I think. So perfect.
Okay, awesome. So we know about the tax rates, we know about capital gains. And again, the capital gains tax is a lower tax, and it's only on the percentage that's debt leveraged at overall like average of the last year, whatever that you sell the property. So a lot of people, when they hear, okay, well, my IRA is going to incur UBIT or UBTI, and I'm only going to be making this much money in the IRA, and these tax rates hit the top bracket very, very quickly. A lot of times they think that that investment might not be profitable. Now, once it comes down to the overall calculation where it's like, the UBTI is only on a percentage of the profits, then when you file the 990T, you can, minimize it by those depreciation and expenses. Do you usually see a lot of people, really only end up paying a small amount of UBTI, or does it end up being a big chunk of their income? Is there any way that, that there's kind of like a trend there?
So first of all, just like in our real life out here as individuals, right? If you're paying taxes, it's because you already made money. So if you're paying UBIT, it's because you already had a profitable investment, right? And it's still going to be profitable after you pay tax because the tax is a percentage of a percentage. But to answer your question with a common scenario, it's very often that folks have some losses carrying over the life of the rental property due to their expenses and their depreciation, and they can also take a deduction for various fees that they pay out of the IRA and so on. They'll usually have some losses carrying forward that help to offset that gain on the sale of the property. Obviously this is a case-by-case kind of thing, and how much tax you're going to pay on it depends a lot on how leveraged the property is when you sell it. Mm-hmm. In some multifamily investments, they will sell the property without ever refinancing it. In others, they sometimes refinance the property close to or midway through its life, and then that would result in you having a higher debt balance at the time the property sells, and therefore more of it would be subject to UBTI. Mm-hmm. So it just depends on the scenario. But again, I would say if you're paying taxes because you made money. And I think if you compared to what the tax would look like if you own that individually instead, then I think it's usually not a wildly different comparison unless you don't make any money at all personally and that gain is your only income. Because in real life, as an individual, you'd be paying tax on all of it, albeit maybe at a slightly lower rate. So yeah, that's what I have to say about that.
Nice. Yeah, no, great answer. That's kind of exactly what I was looking for there, because we do get a lot of people that are like, they think, oh, my IRA is tax deferred or tax free. They get really excited about that. Then they hear about UBIT and it's like everything kind of changes. And then it's hard for a lot of people to find a good CPA that's a good UBIT resource. And, at Quest, we can't really do that calculation for them. So it's kind of scares a lot of people sometimes. But we always say at Quest, UBIT is not something to be afraid of. It's just something to be aware of and kind of have the right resources on your side. You also mentioned something about carrying over losses. Now, this is something that I think is correct, but I'm going to run it by you just to see. In order to carry those losses forward, would an IRA have had to file a 990T in previous years to report those losses and then have them offset? How does that work?
This is an amazing question because it's a question that has no answer.
Oh.
I get asked this question probably 50 times a year. And so by now I have developed a very standardized and responsible response to this question. And it's that the authoritative literature doesn't say whether a 990T has to be filed in order to preserve and carry forward losses. And what my clients often choose to do is to hold off on filing any 990Ts until the first year that they're required to because they have income, which basically means, if you buy a property, let's say you bought a property in 2016 and it has 3 years of losses, 16, 17, and 18, and then you sell it in 2019 and you have a gain, you'd be required to file a 990T for 2019 because you have UBTI. Mm-hmm. What I would do is file that return showing the gain and then showing the losses that carried over from 2016, 2017, and 2018, offsetting the gain. I've done that a number of times, and I have not yet been contacted by the IRS to be told that that doesn't work. And there is nothing in the authoritative literature that says you can't do that. Some people decide that they're more comfortable with filing those returns in all of the loss years just to make sure that they have those losses preserved. And I have to say that I think it's a personal choice for the account owner. If it were me and it was a big loss that you were carrying over, like tens of thousands of dollars, then I would probably think about trying to preserve those losses by filing a return. But, everybody has to make their own call on that one, I think.
Yeah, definitely. And definitely something to consider too. I know I think of, my brain is kind of thinking of how busy my life is. Sometimes it might just be easier to go ahead and file it year by year. That way, you don't have to go back and account for those previous years, but up to the personal preference. That's a great answer. That's actually a little bit different than I was thinking. So I'm really glad I asked that.
To your point, you made a great point just now. It is often difficult to find documents 5 years later. So if you're the type of person that struggles with maintaining records and having those available for your tax folks, you might just want to go ahead and file the return every year so that that's been documented and you don't have to worry about it.
Yes, for the sake of your CPA. If you're not good with that stuff, do it easier.
I had a situation this year where, the guy couldn't find the K1 copies from the previous years, and then he had to go back to the CPA that prepared the partnership returns, and they didn't have copies either. And so then we didn't get to utilize any losses that were back there because we were never able to find the documents. So it's what it is.
Nice. Yeah, definitely some things to consider if you're weighing out those options there. And one very important thing, so I know when someone does an investment with their IRA or Quest has its own tax EIN number that we use for all of our IRA's investments. Now, if someone's IRA is filing a 990T, do they have to get their own EIN for that 990T?
Yes, they do. So they would need to go to the IRS's online EIN application system and apply for an EIN as an IRA. And I've helped folks do that. So if that's something that you need to do and you're not sure, you can reach out to me and I can give you some pointers on that. But definitely you need your own EIN for your IRA if you're filing a 990T, because otherwise they won't know who the IRA belongs to, right? They'll think that Quest IRA or Quest Trust Company has 870 990Ts to file. So
yeah, nope. Yeah, and that's something, because we have actually had people file their 990Ts before. When someone does an investment, they put just the general Quest EIN number on there. So we have had a lot of people just assume that that's the EIN for the 990T, but no, if your IRA is now a taxpayer, it needs its own tax identification number, but it's pretty easy to do that. You can just really go online and do that pretty easily.
That takes like maybe 10 minutes. It's not a big deal.
Yeah. And which kind of leads right into the next question. If you guys may have picked this one up already by now, but am I able to pay the taxes myself, or do they have to be paid from the IRA?
Yeah, the IRA has to pay its own tax. If you paid the tax on behalf of the IRA, that's really a deemed contribution to the IRA, subject to the IRA contribution limits. Not besides it being, potentially a problem if you're already at that limit or you don't qualify or whatever. It's also a hassle to have to show that as a contribution to the IRA because you already paid the tax for the IRA. So if your IRA doesn't have the money and you're eligible to make a contribution, then by all means put the cash in the IRA and use that to make the payment. But really, really strongly recommend that you maintain a sufficient cash reserve within the IRA to pay the UBTI and also to pay any professional fees associated with the 990Ts and things like that.
And that's a very good point as well, because at Quest, we as a custodian do not file a 990T since, we're not authorized to give tax advice or things like that. So if your IRA does incur UBTI, you do need to contact a CPA such as Adam Barr that can help you prepare the 990T. And then basically how that works is you send that to Quest, and our accounts payable department will send that UBTI payment out to the IRS for your IRA to make that payment. I would say, if you are low on funds in the IRA, we always look at, have you made your contribution? Do you have other IRA funds you could transfer over to Quest, or maybe like an additional rollover? But if you're looking to go the contribution route, do us all a favor, put the money into the IRA first, then have Quest pay the UBIT. It is a much cleaner process that way.
Please do it that way. Yes.
Awesome. So, okay, are there any potential pitfalls to watch out for when using self-directed IRA accounts as an investment vehicle?
Absolutely. The biggest one is prohibited transactions, which is a place that you can get yourself in trouble very quickly and have some very serious repercussions if you don't respect the rules. Basically, the IRS rules say that you and various members of your family, which doesn't include everybody, but includes most people, and we can talk about that, but you can't self-deal with your IRA, or it's called a prohibited transaction. So you can't pay yourself any form of compensation from the IRA. You can't provide services to your IRA outside of just managing the investments in the account, anything like that. So just a couple of examples of what this would mean. If your IRA operates a business, like it's doing flips, or it's operating a restaurant, I don't know, and you work in that business, that would be a prohibited transaction. And it'd be even worse if the IRA paid you a salary. That would be very bad. Don't do that. Another example would be if you have a rental property owned by the IRA, then I really strongly recommend that you hire a management company to manage that property, because even as the IRA owner, you're not supposed to be managing the property because you're really providing a service to your IRA, which would be a prohibited transaction. I do want to take a brief moment to talk about the consequences, because they're really bad. If you commit a prohibited transaction and the IRS fines you, and they say you did bad, you did a prohibited transaction, what's going to happen is that basically as of the first day of the year in which the prohibited transaction occurred, your IRA ceases to be a tax deferred account, meaning that the entire balance of your IRA will immediately become taxable income. And that's bad. So.
Yeah. And especially because they usually don't catch it, 3 weeks after it happens. They're not going to call you up and be like, hey, you did a prohibited transaction. Right. It's probably going to be months or, years later, and that kind of all accrues. It's basically ceases to be an IRA, tax distributed and penalized. So luckily for you guys, you have Quest, who are nerds when it comes to IRAs, and we can help to answer all of those prohibited transaction questions for you. We can't tell you how to structure your deal, but we can tell you what's allowed, what isn't, what might be in a gray area that you should consult your attorney for. But, we can definitely help to answer all those questions. But definitely a great point to bring up, because your IRAs get awesome tax advantages to help you save for retirement. So that's where you get your benefit, is when you take your money out at retirement. Not right now. You get these tax advantages to shelter it, but it's not your own business that you're kind of like self-dealing in today. Very important point. But kind of going back to flipping houses and running a business, this is something that, you hear a lot of differing opinions on, where, okay, well, I'm just doing investments in my IRA. I can buy real estate investments with my IRA. Is that necessarily running a business? Or if I do just a lot of deals in my IRA, at what point does it become running an ongoing trade or business where it might trigger UBTI?
Yeah, I get this question a lot too. And usually it's exactly how many houses can I flip before I have a trade or business of flipping houses? And unfortunately, the IRS didn't decide to make it that easy on everybody by specifying a specific number of, this is how many houses you can flip before you're a house flipper. So the general understanding in the accounting industry, both for UBTI purposes and for regular tax purposes, is that what really matters is a few things. Chiefly is your intention when you bought the property. And also volume does matter, but there's no magic number. So let's sort of talk about what each of those means. The intention you had when you bought the property is one of the most important factors in determining whether this is a trade or business or not. If your intention is to buy a property and hold it long-term as a rental property, then that wouldn't be considered a trade or business in the sense that we're talking about under the UBTI rules. If you bought a property with the intent of flipping it and selling it for a profit, even if it's only one property, I think that you have a trade or business. So then, you get into some gray areas because you might buy a property for one purpose, but ultimately it serves a different purpose than what you had intended. So if you buy a property intending to use it as a long-term rental property, and then it turns out that property, for whatever reason, isn't a good rental property, doesn't suit that purpose, you might just, have some quick repairs done to it and then sell it at a profit, which looks like a flip. But I think that you have a case to make that your intention was that this was going to be an investment property. So it's a bit of a gray area, and it's going to depend on your individual facts and circumstances. But if you're trying to find the line, you've probably already crossed the line. So just be very mindful of that.
Nice. And this isn't something I asked you before, but is this something that you see the IRS really going after much? Who really regulates UBTI? Who's policing it right now? Is it something that they are going after actively? What do you kind of see there?
Since the UBTI rules were instituted, over time, the IRS has started to pay more and more attention to the taxation of IRAs. The environment today is much different than it was 5 or 10 years ago. I do think that the IRS looks at the 990Ts that they get, and I haven't received any notices back telling me that there's problems, and I think that it's because I filed them correctly. But I do hear stories about people getting into trouble by misreporting things, or they report something different than what's shown on the K-1, and the IRS comes back to them and tries to collect more tax, or it's not something I'd play around with for sure.
Nice. Just curious on that, because it's a big gray area. No one really knows who's what is UBIT, who's going after it, what do I need to do for it. So this is all really great information.
To your point, I think that there are a lot of people that choose to ignore the filing requirement for 990T. I just get a feeling, based on the ratio of K-1s that I prepare from multifamily rental properties to IRA owners, the ratio of that to the people I actually hear from about 990Ts, I'm concerned that there are a lot of people ignoring the filing requirement, and I think they do so at their peril. I don't think that the IRS is actively pursuing the non-filers at this point in time, but that doesn't mean they won't start doing it in the near future. And if you've been ignoring the requirement, you have 8 years of unfiled tax returns where you owe tax, that's going to turn into a situation. And it's going to turn into a situation with a lot of penalties and interest. So, for what it's worth.
Yeah, so definitely probably better to be safe. You want to make sure that things are filed accordingly, no matter what type of entity you are functioning under. So we've got a question in here. This one answer takes up about 2/3 of a page, but it's really interesting because I am also a nerd for legislation. There were some new rules to do with UBTI, I believe, that were introduced by the Tax Cuts and Jobs Act. What are those, and could you give us a brief overview of what we should know about that?
Sure. Yeah, so the Tax Cuts and Jobs Act, which is the big tax reform we got a few years ago, changed the rules for tax-exempt organizations, which includes IRAs, for UBTI purposes, and said basically, if you have multiple activities in your IRA, then the losses from one activity can't offset the income from a different activity. So you might end up in a situation where you have a loss here and you have income here, and you have to pay tax on this income, and you can't offset it with this loss. And everybody said, whoa, that's not the rules that we had before. That's way different, right? Because somebody who owns a self-directed IRA might have 4 or 5 investments in different LLCs that they're getting K-1s from, and one has a loss and one has income. And I have to pay income tax on this one, even though I had a loss over here. So the AICPA, which is the American Institute of Certified Public Accountants, and other bodies, went back to the IRS with feedback on that, basically saying, hey, that's not really cool, guys. And 2 summers ago, in August 2018, the IRS released Notice 2018-67 and said, well, that's not really what we meant. It's not every single activity that's considered separately. It's every separate trade or business that you have, which still left some ambiguity, right? Because if I have well, let's back up a sec. So one of the tests that they provided in that notice is if your activities have the same business activity code or NAICS code, then you can offset the income and losses by treating those as one trade or business for purposes of UBTI. However, that implied by the other side that if they don't have the same business activity code, then you cannot offset the losses from one activity to the income of another activity. So, I had some clients that were worried about, hey, I've got an investment in a multifamily property and I have an investment in a strip mall, which don't have the same business code. One is non-residential and one is residential. So I can't offset the loss from one to the income to the other. And at that point in time, to the best of our knowledge, that was true. But then we got some great news with some proposed regulations that came out last month. And the IRS said, well, the business activity code really only includes the first two digits. Now, I don't know how much of the audience is familiar with NAICS business activity codes, but basically it's a 6-digit code that specifies what business your business is. Like, for example, code 531110 is lessors of non-residential property, I think. If I'm wrong, everybody can make fun of me, but I'm pretty sure that's the example one. So in that example, that 6-digit code specifically means you rent non-residential property. But the first 2 digits of that code are much more general in nature. And the 53 that the NAICS code starts with is all businesses that are related to real estate, rental, and leasing. So the IRS came back in the proposed regulations from last month and said, okay, if the first 2 digits of the code are the same, you can treat these as one trade or business for purposes of these silo rules, and you can combine the income and losses from those activities. So in the example of my client who gets a K1 from a multifamily real estate investment, gets a K1 from a strip mall, which is non-residential. Since those both have activity codes that start with 53, signifying real estate, rental, and leasing, they can combine those as one activity. And so the silo rules for the offsetting of the income and losses have become less and less heinous over time in a way that makes me genuinely happy. So I think we're good.
That's good. It's, there's always fluidity with the IRS, things that they release, then more guidelines, then there's always someone who kind of, it's great that we have these organizations like whatever it was of the accountants.
Oh, yeah. AICPA, yeah.
Yeah, if I were you guys, I would pay attention to those organizations in your field, because a lot of this legislation could end up affecting you when you don't really have that much education about it. So kind of familiarizing yourself with those certain types of groups can really make a big difference in, all of your investments that you do, because there is a lot of legislation that's proposed by people that are not full-time real estate investors that don't really understand the full ins and outs of that. But, that's for a conversation for another time. Now,
do you mind if I make one clarification on what I just said? I just thought of it. Those are proposed regulations, which means that they basically aren't finalized yet. So this kind of tells us what the IRS's intention is, but it's not like it's set in stone for the rest of time. We have to wait and see what the finalized regulations say. And given that, the IRS is a bit understaffed at the moment, that could take a little while. So just disclaimer.
Yeah, I have a feeling that might not be the very first thing on their list right now, with CARES Act, everything else. Yeah. Okay, perfect. Well, this has all been great so far. We have one last question, and that is, Adam, do you have any additional tips for minimizing the tax liability of your self-directed IRA?
Yeah, sure. First of all, you need to make sure that you capture all of the expenses that you're eligible to deduct against your UBTI. So a lot of folks may not think off the top of their heads, but if they're paying account fees or if they're paying someone to do the 990T for the IRA, both of those things are deductible expenses against the UBTI of the IRA and can reduce your tax. And so I always try to sell that to my clients and say, hey guys, you got a bill from me, but really it's only 75% of that amount because you get to deduct it. And people don't find that amusing. So that's fine. The other, I have two more good tips. We talked about one of them earlier, which is if you're going to sell a property, that's debt leveraged and you have the ability to pay that off more than a year before the day you're going to sell it, then you won't pay any taxes on the gain at all if it's at least 1 year and 1 day paid off by the time you sell it. The other would be another 1 year and 1 day rule, which is if you're going to sell a property that's debt leveraged and you know that it's going to be debt leveraged when you do sell it, make sure that you've owned that property for at least 1 year and 1 day before you sell it. And what this does is it changes the nature of the gain from being a short-term capital gain to being a long-term capital gain. This is important because short-term capital gains are taxed at ordinary tax rates. So if you held that property for less than a year, you could be paying tax up to 37% on the gain on the sale of the property. Whereas if you had held it for at least 1 day more than 1 year, it would be a long-term gain and only be taxed at about 20%. As we talked about earlier, maybe somewhere between 20 and 25, but still a very significant differential in the tax rate that you're paying on the UBTI.
Mm-hmm. Nice. So this has all been really great information. Thank you so much for joining me today. I hope you guys out there enjoy UBTI as much as we do. I know it's personally one of my favorite topics just because it is one of those things that not enough people are talking about, and it definitely can get a little complicated. So it's great to have the right people and resources on your team that can help you out with things like that. Now, remember, just because I do have to say it, at Quest, we do not endorse or recommend or affiliate with any products, services, or investments. But Adam, if someone is interested in reaching out to you and finding out more about, how to calculate their own UBIT if their IRA is incurring it, how would someone reach out to you? Where can they get more information?
So, obviously, you could email me at abarr@mgallp.com. And you can also go to mgallp.com, which is our website, and submit an information request or submit an inquiry through there. And if you just mention my name, it'll go to me. Or you can give me a call if you want to talk on the phone. And my direct line is 713-982-7820.
Nice. And I know today we've been talking for almost an hour about UBIT, super fun stuff, but do you offer other services? I know UBIT is probably only a small portion of what you do. What other fun CPA things do you do for your clients?
Sure. I handle UBIT for a number of clients, but it represents a fairly small area of my practice. I do a significant amount of work in real estate, especially in multifamily and commercial real estate. And I help people, basically plan for what's the tax effect of selling this property going to be. And, I help them with their tax returns for those real estate investments and all that. We also do a lot of business tax. So, I have a lot of clients who are small business owners and they own, a manufacturing firm or a professional services firm or whatever it may be. Really, that's the heart of what we do, is we're here to help small business owners, both with their tax compliance and their tax planning, but also with their general business questions. We have clients ask us a lot of questions about, where to get a good loan, or do I know a good attorney for this and that? Mm-hmm. And we've had a lot of questions lately about the payroll protection loans coming from the SBA and how to account for those. So we're here to help with any tax, accounting, or even just general business advisory needs that folks have.
Perfect. Awesome. So once again, Adam's contact information will be above and below us. We'll go ahead and superimpose that in with all of our fun video editing skills. So thank you for joining us today. Everyone out there in the YouTube world, if you guys enjoyed this video, be sure to comment and let us know what your favorite part was. Or if you have more questions, feel free to send them in to us, comment, share this video with your friends, and we will see you in the next video with our next guest. See y'all later.